Welcome back. You tune into Market Fatafat. Well, the new US tariff on India should not be viewed as a reason to exit domestic equities. Jefferies strategist Christopher Wood, that's what he says, calling them instead a reason to add exposure. My colleague Varun is here with more on what the report says. Over to you, Varun.
Definitely. So Jefferies' greed and fear report actually says that the previously discussed 50% tariff with the US are not a reason to actually sell Indian equities. In fact, they say that rather it is probably a reason to buy the Indian equities because it is their view that it is only a matter of time that before Donald Trump backs off the stance which is not in America's actually interest. Also, they say that Donald Trump has actually succeeded in bringing China, India, Russia and Brazil together like never before. On the markets, they say that actually India represents the best long-term structural story in all over Asia, and actually India has just suffered its biggest period of underperformance over the past 12 months in global emerging market context. Also, they say that the Nifty is still trading at 20.2 times one-year forward earnings, which is down from the peak of around 22.4 times which used to be in October 2021. And following previous such periods of underperformance, they believe that Indian markets actually tend to bounce back after such relative basis. So it's a time to actually buy Indian equities. Also on Fed rate, they say that the money markets are now discounting a 63% chance of rate cuts by the end of the year. Earlier, this was actually around 57%. So the hopes of rate cuts are actually now increasing, and also Jefferies believe that there could be a rate cut in the month of September in the US markets. So if you look at the overall report, it is actually positive on India, and also you will see more rate cuts. In fact, the rate cuts, hope of rate cuts is increasing in the month of September from the Fed.